Car loans are a popular means of financing a new car purchase, but many people fall victim to common misconceptions surrounding them. In this video, we'll be debunking some of the most prevalent car loan myths, starting with the first. As someone who has personally experienced the negative effects of these falsehoods, I am passionate about educating others and ensuring that everyone is fully informed about the realities of car loans. By being aware and informed, you can make the best decisions for your financial situation. Be sure to subscribe to Money Motivated for more informative content on managing your finances. How much to finance? While it may seem intuitive to assume that the more you finance, the better your credit score will be, this notion is actually a myth. The truth is that the amount you finance does not directly affect your credit score. Rather, what really matters is whether or not you make your payments on time. That being said, it is true that financing a car can help improve your credit score. However, this is due to the type of loan being used, an installment loan. This type of loan involves making fixed payments over a set period of time, such as a 3-year loan. As long as you make your payments on time, an installment loan can positively impact your credit score. When buying a car for the first time, it is not necessary to finance as much as possible to improve your credit score. In fact, it may be more beneficial to finance a smaller percentage of the car and pay it off over time. By making consistent payments on a smaller amount, you can still improve your credit score without incurring excessive interest costs. In conclusion, while financing a car can help improve your credit score, it is not the amount of financing that matters. What truly counts is making your payments on time over a period of time. At the end of the day, lenders are looking for responsible borrowers who can reliably make their payments. The next myth to be addressed is the idea of when to refinance. When to refinance? Many people believe that they cannot refinance their car for at least 6 months after purchasing it, but this is a common misconception. The truth is that you can refinance your car loan at any time, even the day after you buy it. There is nothing holding you back from doing so unless it is explicitly stated in your loan contract. It is highly unlikely that this is the case, and any salesman telling you to keep your loan for 6 months is likely to do so to receive a kickback. If you feel like you have a high interest rate on your car loan and could get a better deal elsewhere, it is worth considering refinancing. Your local credit union is an excellent place to start. They can help you review your loan contract and ensure everything is in order. Keep in mind that to refinance, you will need to pay off your existing loan. If you are unsure whether your current interest rate is good or bad, research other loans available on the market. Compare the rate you are paying to the best auto loan rates offered by your local credit union. If your rate is significantly higher than what is available, refinancing may be an excellent option. In summary, do not let the myth of a 6-month waiting period deter you from exploring the possibility of refinancing your car loan. Check your contract and do your research to see if a better deal is available. Car payment priority. The myth that the monthly payment is the sole determinant of how much you can afford when it comes to auto loans is widespread. People believe that as long as they can manage a payment of $500 or less, they can afford any car with that payment amount. However, this approach can be dangerous and lead to financial difficulties. Focusing solely on the monthly payment can lead to financing a more expensive car than you can afford, resulting in negative equity. Negative equity means you owe more on the car than its actual worth, making it difficult to sell or trade it in for a new one. This can put you in a cycle of car loans and financial problems. To avoid negative equity, it's crucial to focus on the total cost of the car, including interest, fees, and depreciation, and consider the loan length and the car's depreciation rate. While a longer loan term may seem tempting to reduce your monthly payment, it can result in more significant problems down the road. Taking the holistic approach to auto financing by considering your budget, long-term financial goals, and the total car cost can help you make an informed decision. Don't let the monthly payment be the only factor, and avoid the myth that a certain payment amount determines the car you can afford. Car affordability. Determining how many cars you can afford is actually simple. To avoid going underwater, make sure not to take out a loan for more than 60 months and put 20% down on the car. Although it may take a while to save, it's the only way to do it. After the 20%, ensure that your car payment doesn't exceed 10% of your take-home pay. This is the amount you receive after taxes. As long as your payment stays within 10%, you're good to go. The next myth to address is dealership financing. There is a misconception that financing through a dealer will get you the best rate because they can compare rates from different lenders. While this is partly true, however, some dealers may have a finance reserve, which means that if you get quoted a higher rate than what the bank is willing to give, they keep the difference as profit. This means that you could end up paying more than you need to, and the dealer is making money off of you. To avoid this problem, it is advisable to get pre-qualified from a local credit union. This way, you have a fixed rate that has been established, and you can avoid any headaches involved in the financing process. It's important to note that not all dealers operate in this way, and some offer competitive rates without any hidden fees. However, it's always better to be informed and prepared before making any financial decisions. By doing your research and getting pre-qualified, you can ensure that you're getting the best possible rate for your car loan. Manufacturer financing. One common misconception is that manufacturer financing is always the best option when purchasing a vehicle. However, this isn't always the case. While a 0% financing offer for up to 72 months may seem like a great value, it's important to consider if you're giving up any other benefits in return. Often, manufacturers offer cashback rebates and financing deals separately, so it's crucial to do some basic math and understand what you're giving up by choosing one over the other. For example, if you could get a 3% interest rate on a $20,000 car loan, or take advantage of a 0% financing offer but lose a $3,000 cash rebate, it's important to compare the numbers to determine which option is truly the better value. Ultimately, the decision whether to take advantage of manufacturer incentives or not will depend on the specific vehicle being purchased, its cost, the rebates and interest rates available, and what is included in the contract. Thanks for watching our video on the common myths surrounding auto loans. Remember to take a holistic approach to auto financing and focus on the total cost of the car. If you found this video helpful, please like, subscribe, and leave a comment below with any questions or thoughts you may have.